There is going to be a catastrophe over the next 2 years. If you're thinking about buying commercial real estate right now, don't. You need to wait until blood is in the streets and you can get deals at rock bottom prices. Everything is going to hell in a handbasket, is what I would say if I was trying to convince you the real estate market's going to crash. But is it actually? Today, we're going to take a look at why fears about the market crashing are overblown and what that means for you as an investor. Now, real estate investing and really investing of any kind carries with it some degree of risk. But you know what doesn't? Hitting that like button and the subscribe button down below. We're a new channel, it would really help us out. All right, let's get into it. The first thing people will tell you if they're trying to convince you you shouldn't buy right now is, so I'm making this video in February 2023, and over the last 6 months, we've seen a pretty decent fall in real estate prices. This slowdown is making people interested in the commercial space wonder if cap rates will expand in a similar way, which would lead to lower prices. The first thing I want to clarify is that while housing prices have fallen somewhat, I don't think they'll fall at the same level they did in, say, 2008. In the Great Recession, housing prices fell by 20% on average. And although I definitely don't have a crystal ball, Morgan Stanley has predicted that housing prices will only fall 10% by 2024. Now, I think this is a reasonable prediction because the factors that led to the Great Recession are different than the factors that are leading to the current downturn. Also, this is Morgan Stanley, and I trust they know a thing or two about losing money. Let's also not ignore the fact that housing supply in 2023 is different than housing supply in 2006. But the other thing I want to point out is that the residential real estate market and the commercial real estate market are not necessarily correlated the way that a lot of people assume they are. This is a much broader topic than I want to cover in this video, but let's take as a general example the difference between home renters and home buyers. Multifamily or apartment real estate makes up a big chunk of the commercial space, and the fact is, people always need a place to live. Generally speaking, if they're not buying, they're renting, which means that the residential and commercial markets can't be directly correlated. Now, we've been talking about things at the market level, but one really individual level problem for buyers in the commercial and the residential space is that one of the biggest conversations about the future of real estate markets recently has revolved around the fact that there's an unelected bureaucrat in the Federal Reserve telling us to prepare for a long and bumpy road. Which, yeah, to combat really high levels of inflation that we saw the last 2 years as a result of the pandemic, the Federal Reserve has jacked up interest rates by a few hundred basis points over the last year. We don't know if or when they'll come down again, so it's reasonable to assume that we might be dealing with these higher interest rates for at least a little while. And I think that this is actually the most compelling argument for some, let's call it, ongoing frustration with the real estate market. Because of high interest rates, we're now seeing commercial properties trade at a lower cap rate sometimes than the interest rate that you could get on a loan to acquire them. Let me unpack a little bit what that means with an example. A property's cap rate is the yearly operating income divided by how much it could sell for. If you buy a property that produces $50,000 a year for $1 million, the cap rate is 5%. Now, one of the simplest and most widely used strategies for acquiring an investment property is to take out a commercial loan that will cover the majority of the purchase price and pay the difference in cash. Having this loan means you have to make mortgage payments on it every month. If we apply that strategy to our $1 million property I just described, when the interest rate on the loan is 3% and the loan covers 75%, well, that might be just fine. For a loan amortized over 30 years, that would mean you'd be paying around $38,000 a year in debt service. This would give you a cash flow of $12,000 a year. But as the interest rate goes up, so does the amount of debt service that has to be paid until eventually you'd be losing money trying to pay this loan. So what if instead of 3%, you take out a loan at an interest rate equal to the cap rate, 5%? Well, there's a good chance you wouldn't be able to make those payments. And if the interest rates are even higher than the cap rate, as we're seeing with a lot of properties on the market now, that's pretty much guaranteed. So does this mean that everyone's dead in the water and prices have to come down if business is going to continue? No. Now that would be true if the only way to get an investment property was to use a loan in the way I just described. But there are a lot of investors and a lot of capital out there that's willing to either pay in all cash or acquire properties in more creative ways. Creative acquisitions are what I'm doing this year, and there are a ton of savvy investors doing that this year as well. So under those conditions where people will still buy properties even though the interest rate is high, would you come down on your price if you were a seller? Now, okay. That's all fine and good for people who want to sell but don't have to. But what if you're losing money and you have to sell? Enter what I call the bridge loan catastrophe. I don't know if y'all noticed, but a lot of commercial property got sold over the last couple years, like a lot. A lot of that real estate was bought with bridge loans. Now, bridge loans are a little bit different than the types of loans I described earlier. Bridge loans are typically interest only, and they come due in 1 to 3 years. That low cost makes it perfect for projects that aren't making a lot of money right now. Like, let's say you want to buy a vacant building and turn it into student housing. Here's the risk though. The plan is to be done with the renovations or construction before the loan is due so that you have time to sell it or refinance into a longer term loan. But what if you aren't done? What if your bridge loan is coming due in 6 months and you're 18 months away from completing the project? The bridge loan catastrophe, or BLC as I like to call it, is the idea that there are a lot of deals right now in that exact situation. A bunch of new commercial syndicators, a bunch of young guns, inexperienced, wet behind the ears, that deployed hundreds of millions of dollars of investor capital to take out risky bridge loans for projects they didn't know how to run. The idea is that because there are enough of those that need a quick sale, it's just a matter of time before you'll be able to get properties so cheap you'll wonder why all us idiots didn't just time the market. Except that's not going to happen. Now, don't get me wrong. The past couple of years, there have been a lot of inexperienced syndicators that were taking on projects that were, in hindsight, maybe a bit too risky. But to explain why this isn't going to happen, imagine if you were one of those syndicators. Now, just imagine for a moment, you're one of those syndicators. Your name's Vince. You drive a BMW. It's your dad's BMW. Now, Vince, imagine you're in the situation I just described a minute ago. Your bridge loan is coming due in 6 months, and you're maybe a year and a half from finishing the project, maybe. So what are you gonna do? Well, the first thing you could do is sell the property to somebody who wants to take on a half-done project at a discount. If you do this, your investors will be very unhappy with you because you've lost them a lot of money. And since word gets around and your name is now mud, it's very likely that nobody will ever want to give you their capital again. So that option's probably the worst one. Now, another thing you could do is sell the property for just a marginal gain. As I described, there are still investors that want to acquire properties even if they can't do it the way they used to. This would be a better option because even though you can't execute the project the way you wanted to originally, at least your investors are getting their capital back in a pretty short time frame. The last option is to find some way to dilute your equity by bringing in more capital from investors. This can be done through a capital call to existing investors or through what's now called rescue capital from outside investors. In the second case, that sometimes means the GP team has to give up some of their equity and or allow the rescue capitalists to have a hand in major decisions going forward. Now, this isn't ideal either because your investor's return is being diluted, but there's a good chance that with the help of the new capital and the new operators, your project will complete successfully. So what are you going to do, Vince? You going to tank all your credibility by selling at a loss and losing your investors a bunch of money? Or are you going to take one of the other options? And that's why the bridge loan catastrophe is not real, because Vince wants to take one of the options that means his company has a future. And in all but the most risky of cases, he can and will. So, is the commercial real estate market going to crash? Probably not. Maybe, but probably not. If it does, I'll make a video saying how I was wrong and you can make fun of me. And since I'm buying deals now that make sense, and I'll continue doing that if there's a crash, we'll both be happy. Because here's the takeaway. Here's what this means for you as an investor. The market does not determine whether or not there are good deals to be had. If a deal works in an up market, but it doesn't work in a down market, It's not a good deal. A good deal bought now will be a good deal in 6 months, whether or not prices drop. So even though this is a boring conclusion, at least it's consistent, because it doesn't really matter what the market is doing at any given time. Operators that care about operational excellence and risk mitigation and bringing great service to their tenants will always be a good bet. Thank you so much for watching, and I will see you soon.